If you've ever noticed unusual market activity on certain Fridays in March, June, September, or December, you may have witnessed quadruple witching in action. It's a term that sounds like something out of a fantasy novel, but in reality, it refers to a powerful event in financial markets. So, what exactly is quadruple witching? It happens 4 times a year on the third Friday of March, June, September, and December when 4 types of derivative contracts expire simultaneously. Stock index futures contracts that speculate on the future value of a stock index like the S&P 500. Stock index options contracts based on indexes rather than individual stocks. Single stock futures contracts on individual stocks rather than indexes. Stock options that give investors the right, but not the obligation, to buy or sell individual stocks at a set price before expiration. Each of these derivatives plays a role in trading strategies used by hedge funds, institutional investors, and retail traders. When they all expire at the same time, a high-stakes balancing act plays out across the market. Why does quadruple witching matter? The expiration of these contracts means traders must settle, roll over, or close positions, leading to a sharp increase in trading volume. This can trigger short-term volatility, creating both risks and opportunities. Here's how it impacts the markets. Increased trading volume on quadruple witching days. There's often a significant spike in trading activity. Investors and institutions scramble to adjust their positions, which can drive up liquidity and lead to sudden price movements. Higher volatility as traders unwind positions or hedge against expirations. Some stocks or indices experience dramatic price swings. While some investors use this as an opportunity for short-term profits, others avoid trading during these periods due to the unpredictability. Market distortions. Certain stocks or indices may see exaggerated moves as large institutions adjust their portfolios. This can lead to unusual price action that doesn't necessarily reflect a company's fundamentals. A phenomenon called options pinning can occur when a stock's price gravitates toward a heavily traded strike price as options expire. Market makers and institutional investors may adjust their positions in ways that keep the stock near certain levels. How traders can prepare for quadruple witching. While quadruple witching can present opportunities, it also carries risks. Here are some ways traders approach these events. Be aware of timing. The last hour of trading on quadruple witching days, often called the witching hour, tends to be the most volatile as last-minute adjustments are made. Watch for fake moves. Not all price action on quadruple witching days is meaningful. Some movements are purely a result of contract expirations rather than real buying or selling interest. Use caution with options trades. If you're trading options, be aware that market makers may adjust their positions aggressively, impacting pricing and spreads. Look for post-witching opportunities. After the dust settles, markets often return to normal patterns. Some traders look for opportunities in stocks that were temporarily distorted. Final thoughts. Quadruple witching is a unique event that can create both excitement and uncertainty in the markets. Whether you're an active trader or a long-term investor, understanding how it works can help you navigate these high-volume trading days more effectively. So next time a quadruple witching day rolls around, keep an eye on the market. Will it bring heightened volatility, or will things stay surprisingly calm? Either way, it's a fascinating event to watch.